This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. Before I dive into my trend-following guest today, I have a trend-following request. If you've not taken the time to yet go to Amazon and write a review of my newest edition of Trend Following, come on, what are you waiting for? Go say something great or say something crazy, your choice. But please take the time, go write a review at Amazon. It supports the podcast. It keeps me going. It's the nature of the beast. I hate begging for people to go write reviews, but my gosh, that's the hand we've been dealt by Mr. Bezos in 2018. My guest today, Martin Bergin, president and owner of Dunn Capital, and also James Dailey, the CEO of Dunn Capital. I believe this is Marty's third appearance on the show. I'm not sure. I think it's James' first appearance, recorded in the week after the February market volatility, a wide-ranging trend-following conversation, and diving deep into how Dunn Capital looks at the world and the trend-following world. I hope you enjoy this conversation with Martin Bergin and James Dailey of Dunn Capital. So guys, I've caught a lot of headlines recently. Obviously, a lot of volatility pumping up in the stock market. But that drumbeat, that thing that comes out when the straight up bull market in equities slows or takes a break or goes the other direction, invariably, the machines are blamed. And you know, when I look at something like Dunn Capital, for example, you guys are, as far as I know, you guys are these machine traders, right? And your machine trading goes back to the 1970s, if I'm not mistaken. So it's kind of funny how this machine stuff is novel, and and the media wants to blame people in 2018. But Dunn Capital's known about machines and trading going back to the 1970s. Why don't you tear that apart for me? Because there's a lot of things going on there, and there's obviously always misinformation. But what's your thought when you see the headlines, the machines are doing dastardly things to the equity markets?
Well, I think the first thing we try to do is differentiate between how you define the machines. So yeah, we use computers for basically everything that we do from a systematic nature. I mean, the fund is completely systematic. The computers are used to crunch data, produce the signals, produce the orders. We aren't actually using the machines to execute the trades as much as we do use algos as a tool for our traders to help them execute. I think what people are really talking about when they start complaining about the machines are some of these pre-designed algo trading systems where it doesn't really have human intervention. So they're set up just to react to price data automatically and either start selling or buying. I think one of the things that may have attributed to the significant volatility that we saw in equities this past week was some of these systems, when equities began to fall, they started hitting stops and then selling into the fall. And that just exasperated the situation. And as they sold into it, more and more stops were hit by more and more of these algo systems, and they were continuing to sell. Another argument that I think might be valid is you have some very large trend following funds out there that, as the price moved in such a significant number, standard deviation moves every day, multiple standard deviations, 4.6 one day over 7 standard deviations the next. I mean, this forced a lot of the trend followers that were all holding long equity positions across the board. It was really the only trade that was making money in 17 outside of energies. that may have exasperated the situation because they had to move those contracts. So I think they were coming in and selling in bulk, which may have attributed to these, 200, 300 point, 400, 500 point swings that were occurring intraday. But, all that's theory, and I couldn't tell you for fact what created it. I think there is a valid argument, but the idea that the machines are, tearing the stock market apart is really kind of nuts. In a way, actually make the system more efficient, possibly.
I bring it up in my question, and you do a nice job of differentiating. But the idea of a machine, this, in your history of your firm, this goes back, this is 40 plus years of machines. And I think perhaps, and I'll let you jump with this, people don't often think about, for example, in the Dunn Capital world, what a machine is doing. It's taking the rules that your firm thinks are wise for buying, selling, the right percent to bet based on the capital under management, and automating that into a process, a machine, a computer, is pretty good for that. And it's kind of a strange thing that after all these years, frankly, decades, that still can be misrepresented. And even though, look, the machines get blamed, as you just mentioned, trend following. Trend following gets blamed in these kinds of periods too.
I think more importantly, what the machine does is it takes the emotion out of the decision making. One of the things I think really creates problems for people is they fall in love with a trade. And when you see the market turning against you, you tend to want to hold that position. Instead of reacting to what the market's telling you, you wait and wait and wait, and then it becomes panic selling. And that is where you really start seeing markets drive down, is when you hit that panic button. The machines don't have panic button. There's a certain threshold where you start, if volatility increases, the machine wants to reduce the size of its positions because risk has increased. So it's just a simple calculation of what your risk is, and you reduce your position to get your risk back in line with your expectations. The second thing that then causes it to sell, as this example, in an equity market that's been running as a bull market for so long, is when the price starts moving against it to the point where it doesn't want to be long anymore. So that's the second point that kicks in. And then the third point that kicks in for us is just the way we manage risk, where we adjust our overall risk targets to the market conditions. And as we see the end of trends that have played out over a number of years, then we're going to reduce our overall risk. All these things are good things that happen that because of the machine that may or may not take place if it's an individual making emotional decisions.
Let me get you to elaborate a little bit more on, for example, the headline of a return to volatility. Look, we're going to go down a very timeless, principle, rules-based conversation. But in the moment right now, you have the headlines screaming, return to volatility, the market climate is changing. And that's got to be, I would think, for you and your firm, unusual to hear from your perspective, because you guys have got so much data, so many years of performance. You've seen every market climate that can be imagined for 40 plus years.
Well, let me throw you out another phrase. What do you think about the end of the new normal? Right? So after the credit crisis, we entered the new normal. Remember that phrase? I think we've seen the end of the new normal. It's not that this huge volatility come back. The market's just going back to what it has been in the past. Hopefully. Increased volatility is good for the market.
When you say that, though, back to what it's been in the past, I guess I'd love to pull out of you is that research and data perspective to where your firm has seen, look, the past is always a little bit different than the future, and the past is never, there's no predictive that you can say there. But in terms of climates and data, you guys have seen every climate under the sun. sometimes that simple sounding idea is hard for people to wrap their arms around, that you guys are sitting there right now fully prepared for whatever climate might unfold.
Yeah, that's true to a certain extent, but you have to remember this past year, nobody's ever seen volatility as low as it's been. I mean, from an equity, and it's not only in the equity markets, it was pretty much across the board, extremely low volatility, to the point that we recognized the risk we kind of changed the way we measured volatility. In the past, we always just look at the current volatile apartment with a short look-back period, right? I mean, that's normal in most systematic type trading. But we started viewing volatility in two ways. We look at a long-term volatility versus a short-term volatility, and then we always took the riskier of the two, the higher volatility to calculate our system, because we thought that the current environment was abnormal. How long would VIX continue to trade under 10 and continue to go down? At some point, there's a price to pay when you're dealing in this type of market environment. It's like a rubber band, it just kept getting stretched and stretched and stretched. So what we saw the last week was also something more than we've seen in the past. But we've seen activity like this in the past with volatility spikes. It's just to the degree that's a little different than the past. So the systems, systematic programs are set up to adjust and adapt to these environments. But it doesn't happen overnight either.
On the flip side of that, where you're going, if I was to think back to a period, this is historical, but back to October of 87, there were some moves during that period that were just off the hook. I mean, that was, your firm was able to navigate then as well.
Right, but I mean, it was a similar situation, and we actually were using that period of time to stress test our portfolio for this period of time. So, we have run stress tests over the last 6 months exactly for this type of market move, which basically came about, and we reacted almost very similarly to what happened in 87. 87, there was a huge return. I mean, it went down very hard and quickly and came right back within days. This may take weeks, it may take months, it may never come back, it may just continue to fall. We don't know, but we know the system will adjust for either environment and we'll be fine.
Mike, I get what you're saying, though. This time last year, all the talk from a lot of the people that we see at conferences and questions from people who follow the industry like you was how will CTAs perform in a rising interest rate environment? Because it's been a low or falling interest rate environment for 30 years. We were actually in existence in trading and doing trend following since 1974. So we actually have performance, actual real trading data that we can look at during a rising interest rate environment. And a few other CTAs can as well, who have been around for as long as we have. So you're right. We've seen a lot of environments that newer traders have not. I think last week I read that was from an S&P peak was the largest 10-day drawdown since 1985, and we've been trading since 1974. So we traded through that period in 1985.
James, do you want to offer any perspective, given that you mentioned having that data from a rising rate environment? Do you want to give any perspective? Look, the past is no prologue. We don't know what will happen in the future. But is there any insight, or at least the historical footprint of what did happen in a rising rate environment inside Dunn trading back at that point in time?
We were profitable. There were trends in fixed income and in some of all the other sectors. There were trends to be identified and exploited. Trends will occur in a rising interest rate environment and in a falling interest rate environment.
Think about it prospectively. Rising interest rates really, in most of the time, it's all about inflation. Well, inflation is a trend follower's friend, because that's what we're basically profiting off of. Rising interest rates creates trends in other sectors, which we can profit from. The other thing that's a misnomer about rising interest rates versus falling interest rates is this whole idea that trend followers make a lot of money off the roll carry in a falling interest rate market, which is true to some extent, but the interest rate in the carry is all calculated in the futures price. I mean, people tend to make it a little more complicated than it really is. I mean, all that you're doing is taking a future price and you're betting whether the interest rate goes up as quickly as what the marketplace thinks it's going to go up, or vice versa. Let's say you're in a rising interest rate environment, but the rate doesn't go up as quickly as the marketplace thought. Well, then you're going to be long those bonds, even though it's a rising interest rate environment, which would make you think you would be short. But really, it's a bet on the rates versus market perception of rates. You know, when you're short, it's basically saying that rates are going to rise faster than the market projects them to. And what we tend to be is, when we are short bonds, we tend to not be as short or as convicted in that trade as we are when we're on the long side of bonds. You know, we make money on that trade just like we do on the long side of bonds historically. And nobody knows what the future holds.
When you say, and I've seen you say this, your firm is committed to trend following, it doesn't take much of a leap of faith, even if one is not experienced with trend following, to see a firm that has a track record of 40 plus years with really significant gains, your firm, to say, oh yeah, I can understand why they're committed to trend following. But I think I have to ask the question still, when you say you are committed to trend following, I have to ask why.
Well, it's the only systematic trading method that stood the test of time. I mean, there's all kinds of white papers that have been authored using data that's, you know, hundreds of years old, showing that trends have always occurred since the beginning of time, and they continue to occur. One thing that you used to hear prior to 2008, you know, all the literature and articles and things were being written that trend following was dead. The idea being that computers made information so available that the market adjusts immediately to any change in prices, and therefore there wouldn't be trends. It's always range-bound trading. I mean, processing information just makes the market more efficient. It doesn't mean that trends won't occur. You know, 2008 was a perfect example. Historically, since 2008, we continue to perform well. I don't hear people talking about trends being dead. I think now people appreciate managed futures and trend following for the tail risk protection and the non-correlated nature of our returns. One of the things that occurred this last week, though, is, you know, tail risk protection has always been viewed that if the stock market goes down, managed futures and trend following will do well. And now we have an environment where the market went down, and we also got hurt because basically all trend followers were long equities, just like the market in general. The misnomer there is that people don't understand that there's a difference between a correction versus a pullback versus a recession. A pullback or a correction, like what I feel like happened last week, is where trend followers then react to that data and reposition their portfolio. If we continue to see this transition into a bear market, then trend followers will be short equities and other sectors will become profitable, and, you know, they'll start making money with that given market. Whereas, you know, an equity investor long only, holding investor, they're always going to be in those equities or cash. So there's no opportunity for them to really profit from this market.
If you look at the total assets in trend following portfolios around the world, it's tiny by comparison to, quote, traditional assets. Why don't you go ahead and give the education about this correlation feature for trend following, what you guys do, and comparing that to traditional assets and why it makes so much sense for everybody to have a piece of a return stream that's not correlated to traditional assets?
Well, it's simple math. If you take two completely uncorrelated revenue streams and you put them together, it's going to increase your risk-adjusted returns. So we view it as a core holding of any portfolio because not only is it uncorrelated on a general environment, on a day-to-day investment, but it also becomes negatively correlated during significant crisis environments. So 2008 would be the most recent perfect example where equities are in a bear market and managed futures tend to do well. And it's not just us, but historically, across the board, all managed futures do well. One of the things that we think that we bring to the table that a lot of the other managers don't is we tend to trade with a higher annualized volatility than other traders. We view it from a VAR perspective or a value at risk perspective. And the reason we do this is twofold. One, it allows somebody to allocate to a strategy like us for their portfolio, and they don't have to allocate as much money to get the same bang for their buck. So it's all about allocating risk. We will give you twice the amount of risk for the same amount of capital. Secondly, we're motivated to make money because we don't charge management fees here at Dunn. So since it's all incentive-based, we're incentivized to make money for our clients. The other thing that helps with that is the fact that it's our own money is in the systems right with the client. So we're trading exactly the same strategy that they are. The only difference is I don't charge an incentive fee to ourselves. So for that reason, the correlation enhances the overall value of the portfolio by having core allocations of these types of strategies. The other thing that's a misnomer is people think they can go into the hedge fund space, long, short equities. There's, numbers of hedge funds, private equity, real estate hedge funds, all these different things. But if you look in a crisis environment, they all become very correlated in the end. So even though they're uncorrelated in a normal investment environment, when things go badly, they all become very closely correlated to the downside mostly.
The reason you don't have the correlation is because when stocks go down, you're not just a long-only stock firm, obviously. So you are able to benefit from all these other moves that will happen when the big equity move is on the downside.
Right. We're able to go short just as easily as long. And it doesn't cost a premium to be short. If you wanted to short stocks as a general investment strategy, it actually costs you money to do that. Whereas with us, we don't have to pay to short equities. We just, the futures price, you can either go long or short. It's the same cost either direction. You pay a commission. You put down a good faith deposit, which is defined as margin. That's just a deposit that says you're going to execute on the contract at the end of the holding period.
Let me get you to tear apart a couple things that you brought up in that answer about correlation, though. You brought up the vol targeting, your vol targeting at Dunn. My understanding, and this is a relatively new change for Dunn, I think going back less than a decade, I believe, but 2 levels of vol targeting today. Why don't you explain how that's unfolded and the difference?
We used to target a static monthly VAR of 20%. We were dialed at that no matter what the environment, and we did that from our inception all the way through the end of 2012. So we had a 1% chance of a 20% or more loss in any rolling 1 month period. And that's at the 99% confidence level. We actually penetrated that loss, I think 1.14% of the time.
One of the most amazing statistics I've ever seen in financial data.
It is amazing considering that a good part of that track record, the computing power is not what it is today. So we were very good at dialing to that target. So we have over 341 months from, this is just for our WMA program, which is from 84 to now. We had, I think, 4 penetrations on the downside of that 20% threshold. It intuitively didn't make sense for us to always be dialed to that same risk target when we knew that the market environment wasn't very conducive to our style of trading. So after the debt crisis, for instance, there was a period where, with all the government intervention in markets, there weren't a lot of juicy trends to be had. Markets were pretty range bound and low vol and choppy. And our signal strengths were pretty low, but we were still dialing up the risk to this target that, we're committed to doing everything systematically, and we would never override our program. So we were still dialing to that risk, even though we felt, why are we doing this? It's not really a great environment for us. And so this is something that we had attacked a few times before, our R&D team, and we kind of finally cracked it towards the end of 2012 and implemented it into the program starting January 2013. That's a dynamic risk targeting. So now we target a value at risk that's geared to current market conditions, and it can range from a monthly value at risk of, on the low end, 8% up to about 20-21% on the high end. So what we used to dial to every day, we're now only at our max risk 5% of the time. Over time, our average value at risk on a monthly basis should be 15%.
So, Mike, understand that the point behind this is to reduce the downside volatility and reduce drawdowns, because that seems to be what investors remember the most are significant bad events. Of course, nobody likes to have significant bad events. Everybody likes to have the big run-ups. Part of the thought process behind this was we didn't want to just reduce our volatility for the sake of not having bad events, because we wanted to still be profitable and productive for our investors. By sizing this the way we have, with 5% of the time we're at our maximum risk. Now that's looking back over long historical periods, because we could go for 2 or 3 years without ever getting there, and then we could be there. For instance, recently we got to our maximum risk last September, and we basically have been there all the way through the month of January. That's a long period of time to be sitting at the maximum risk, but of course we made a significant amount of money during that period, well over 30%. When you look at that, it makes sense. There are times when we reduce that bar. The perfect example of that was in 2017. For the first 6 or 7 months of the year, we were at a very low bar, and we actually lost money 6 months in a row. And at the end of that period, we were only down 5.5–6% for the year. It works, and we have enough data that's statistically significant to show that it's done exactly what we would have expected it to do. And yet we can still have the outsized performance that we've had in the past. Because of that, our risk-adjusted returns has actually improved dramatically from the past.
People have a choice, though, with you. There's two different ways they can go. There's kind of the institutional direction, which is what we're talking about right now, but then there's still your standard approach, correct?
Well, no, because the adaptive risk we've applied across the board in everything. So we have our standard volatility program, which is what James was describing, the bar targets. The only difference between that and our institutional product is the institutional product trades at 1/2 of whatever the standard is. I mean, it's as simple as we just reduce the positions by 50% for institutional versus standard.
So the standard product has an average VAR, as I said, of 15. That translates into an annualized volatility over time of 22%. The WMA institutional product, like Marty said, same product. The average VAR over time would be about 7.5, and the annualized volatility over time should be about 11%. And this has been our methodology since January 2013. So we have over 5 years of actual trading data using this approach now.
I want to take you guys in a certain direction for a moment. If one looks at the backgrounds of Dunn Capital principles, the history, Bill Dunn's background as well, there's a certain almost what I want to describe Joe Friday approach. It's like just the facts, ma'am. You know, this is kind of the feeling, and you guys are very comfortable with what you do. Give the audience out there, and this could be experienced people, inexperienced people. We're in this world today where there's this overload of information. I mean, we're bombarded daily, nonstop, right? I mean, I still remember the first time I entered your offices. Yes, it's a long time ago, but still, if I was to walk in today, it's not a trading floor of people jumping up and down and screaming and trying to react to this or react to that. Give people a feeling, like when you guys sit around and talk to each other, give people a feeling for why this approach that you guys go with is so good in this world where it never turns off. It's 24/7. You know, frankly, it seems like most people are at just a heightened state of anxiety all the time. And you guys have got this really great approach. Other people, similar approaches, but you guys have this really great approach. And Marty, you mentioned this at the beginning, the emotion part, but this great approach to keep some of this desire to want to have all of this information constantly, all the time, to keep that in check. I know that's a long-winded setup, but I think you see where I'm going. I want to try and pull that out of you guys.
Yes, there's more information than there ever has been. People are using, quote-unquote, big data, artificial intelligence, black boxes. They're doing all this elaborate computing power to process information. But one of the things I think will never change, and people try to make it too complicated, price data incorporates every bit of information that's available in the marketplace. Some people know more information than the others, and that's all part of the price data. So price encompasses everything that's available to process. We rely on price data. We are doing research into looking at other types of data that's on the peripheral of the price that may help in some way to validate or enhance a signal or give you a little leading information or something of that nature. But the bottom line is price is the most reliable piece of data that you can have. And that's why the system relies so heavily on price. And price alone. I mean, we look at highs, lows, and closes every day in every market we trade. And we use that information to process our signals.
You're right, Michael. Like our office is very, very quiet. Sometimes people who come to visit us, prospects or clients, they're even like a little bit let down when they go to the trading room and there's one guy sitting in front of a computer just monitoring things. Actually, most of the execution happens overnight when the volumes are really high in the markets. But I think it's really, trend following really is, it's about discipline. It's not that exciting. The returns can be exciting over time. But on a day-to-day basis, it's about discipline. It's about blocking out the noise that you're talking about, all the noise in the media and everything that's attacking all your senses. It's about blocking all that out and focusing on the algorithms and the fact that it's a repeatable process that doesn't give into emotion is what I find really appealing. I think most of our investors do as well. They get it.
The other thing is, we're managing money to the long term and not to the short term, which I think if you look over history at all the great investors over time, every one of them was geared to a long-term perspective. The reason that some of them did better than others is Warren Buffett's a perfect example. I mean, clients and investors aren't going to force him to change his philosophy. Nobody questions, Warren Buffett saying he's managing for a 10-year horizon or something of that nature. Barron's is kind of the same way. You hear him talk, and everything he's talking about is holding periods of 5 to 10 years. He's held stocks for 20 years in his portfolio. A newer manager wouldn't be able to get away with that. But when you're looking at trend following, everything is geared toward the data, and the data has shown us that the long-term approach is much better than taking short-term approach. We've been looking for years trying to develop some type of shorter-term trend-following program to enhance our current program. It's just not there. We don't see anything that's consistently profitable over 20, 30 years. So it's still a nut that we're trying to crack. It gives us something to do from a research perspective, along with all the other ideas that we come up with, some of which get implemented in the program, some of which are dead ends, and we just move on to the next project or the next idea that somebody comes up with.
Marty, I think when you made the statement with price data, it encompasses everything. And you've said this multiple times in this conversation so far, that there's a lot of simplicity here. And that statement sounds simple. Everything is, encompasses inside the price data. Sounds simple, but boy, is it a mouthful. There's so much going on there. To have an investment belief predicated on that still can be tough for people to wrap their arms around.
It's simple to a point, Mike, that what happens is when you get into the portfolio development and the risk management, that's when things start getting complicated. I think that's what sets us apart from a lot of other firms is the signal-driven process is very simple. Everything that goes around that enhances it. The package as a whole is not simple. It becomes very complicated when you start looking at risk and you start looking at portfolio development, the way you allocate risk. And there's so many different particulars that play into it. Even from our perspective, if you start breaking down every little nuance, it would take you weeks and weeks and weeks to try to discuss every little thing that's built in. And of course, we wouldn't discuss most of that with people because it's proprietary.
Yeah, when I say simple, I don't mean to somehow or another imply that there's a lack of complexity. That's not my point. More just the idea that you can believe that instead of using, some myriad suite of thousands of data sources, that you have taken the simple idea of making your decisions off price data. That is a simple sounding concept, but the complexity behind accepting that as valid, I just think a lot of people still have a hard time with that.
Well, I think the best investment ideas in history have always been simple. Like James said, you have to block out all the noise and get down to the very simple calculation that becomes obvious at some point. It's like The Big Short. I mean, people look back at what the guy did and think, well, yeah, why didn't I think of that? I mean, and yet he was on the wrong side of the trade, right? He got there too early. But, I mean, conceptually, it made all the sense in the world.
Hey, by the way, where was the trend following component for The Big Short film? Because they talked about all these folks that kind of had this one-off trade where they were going to do really well, and many of them did well for that period of time. But you guys were right there, too. And I don't remember seeing you in The Big Short.
You know what, Michael? It gets to exactly what you were just talking about. It's just it's not as exciting as those individual one-off stories.
Your performance during October of '08 was exciting.
Oh yeah, trend followers had a huge year in '08 and through the first quarter of '09, but it didn't get a lot of publicity.
I'm curious, you guys, obviously, with your firm success and longevity, you see a lot of different things. You hear a lot of different approaches. You see a lot of different approaches. I don't know if you want to comment on this, but I'm still going to ask. You can always tell me no. But are there approaches out there? I'm not necessarily asking for individual names or firm names, but are there investing styles out there right now that have received traction in the last decade that if we do get to one of these periods where things shift, the rising rate environment, are there styles out there right now where people should be concerned about? Other styles beyond trend following?
It's interesting. We're about 2 weeks late, but so over the last year, we at Dunn have been developing a volatility strategy. Part of that was we purchased a firm in Europe and brought over the principal who now works for Dunn, Stefan Vintner. And one of the things that came to light was concern about these short vol products, especially ETFs, that even when you looked at their documents, I mean, it was laid out clearly that they were prone to blow up, especially in a really low vol environment where a move, vol increased by 13 points last week, which is not that significant, but it represented over 100% increase. Well, if you're short vol and vol goes up 100%, guess what? You've lost 100%. There's no more money left. I mean, it's a very simple calculation. And we had been talking about it. We did not predict this happening by any means. We just talked about the potential risk out there. And I think some people I guess it's the greed gene, right? Where they just see the profits and, chasing the dog's tail, right? So this Velocity shares, for instance, I think raised $1 billion in the last 12 months, and it was over $1.5 billion fund that blew up in one day. And people can't say they should have known it was coming or should have known that it was possible. And for them to sit there and say they can't believe it happened, it was a low volatility product, blah, blah, blah. No. I mean, it was, even in their perspective, they told you what would happen. So if you're asking me, is there anything else on the horizon that I'm aware of that would be troublesome? I don't know that there is. There's some strategies out there that I watch that are intriguing to me. I'm always looking at non-correlated investment products that we may be able to incorporate at some point in Dunn. That's why I was so intrigued by volatility products. And our volatility product is not a directional volatility. It's not necessarily short vol or long vol. It more plays off the change in the skew of volatility or the volatility of volatility. It's a second and third component of volatility, which I think is much more interesting than just trading the direction of volatility. And we did well during the spike, and yet we made significant amount of money last year during the low vol period too, and the falling volatility. So we're making, we've proven we can do well in either environment with our vol strategy. So we're looking forward to that. The other thing that I'm always looking at is short-term systematic programs that are either trend following derived or using some other methodology and being consistently profitable over long periods of time. And I think there's a couple of them out there, but I'm not really going to point anybody in any directions.
As I close up with you guys, I think this is a question that I want to ask of every trading firm that I have on this show going forward. So maybe this is kind of my first stab at it. Do you guys have any perspective right now that you would like to share on the the advent of the crypto world?
Well, I never say never. So I think it's pretty funny to see the emotional responses that people give when this is brought up. I mean, it's either, oh, it's the greatest thing in the world, we're going to trade it next week, or are you kidding? I would never trade that in the world. That's the craziest thing. And I think all that's ridiculous. I mean, the bottom line is, if the market matures in such a way that there's volume there to be traded, and you have data, well, why wouldn't I trade it? I mean, it's just another, most likely a very uncorrelated currency that would do nothing but enhance the portfolio. Are we going to trade it tomorrow or even next month? No. But it's something we'll definitely keep on our radar screen if this future market continues to grow. And I can remember when the VIX futures were put out there, and nobody wanted to trade those right away either. But now it's the largest market in the futures world. So there's nothing to say that Bitcoin or one of these other cryptocurrencies, or maybe they'll make a futures basket of all the cryptocurrencies. Who knows? But it could be a market that could be traded at some point in the future.
You just laid out the trend following mantra, though, right? We'll just take it as it comes, and if it's something we can trade and it meets our criteria for trading, and it's got a trendiness to it, why not, right?
Oh, yeah. I mean, we'll trade any market that is on a regulated exchange, has adequate volume that it can be traded without a problem, and there's enough data to put it in the system. Even more so if it's uncorrelated to our existing portfolio, because that's what really will enhance a portfolio, is the more uncorrelated markets that you can plug into your portfolio, the better your risk-adjusted returns are going to be.
Guys, I thank you for participating today. It's always nice. I know, like everyone out there, we've all got our business hats on and stuff, but I think what you guys present is a great educational perspective, whether or not somebody came your way as a client or not. So I appreciate you kind of educating the audience. I think first step is for people to learn and to understand what's going on, and then they can make decisions about potential business relationships if and when appropriate. But that's all personal choices. But again, I just appreciate you guys coming on and giving that kind of nice that college lecture that I don't think you can find too many places around the world where you got professors yet that are kind of going down this path. There's a few, but it's still not regular fare at most universities.
Right. Well, I thank you for what you're doing, because I think the biggest key to our industry and the investment world as a whole is education. You would be amazed at how many times when we talk to a prospective investor or even our existing investors where your name comes up. And so I think you're doing a great job as far as educating the investment world about trend following managed futures and its value in the marketplace. So keep up the good work.
Well, thank you, sir. I think I'm due. It's been a couple of years. I'm going to have to work my way from Southeast Asia down back to Stewart for a lunch at some point in time. But hey, listen, the best place everyone can go, of course, is DUNNcapital.com. Is there anything else that you would like them to know? At DUNNcapital.com, I shall say, they can obviously reach out direct to you guys. And there's a lot of interesting data there, too. So they should dig in.
We have a lot of educational pieces that we provide to prospects and investors as well, and they can gain access to that by registering on our website as accredited investors. And then, we kind of take the baton from you, so to speak, and provide a lot of information about trend following in general, not just trying to promote our products, but we believe in educational marketing big time.
I still think that one of the most powerful educational pieces in existence in the financial world, and I don't think this is too big of a statement, for any young person out there, even, whatever age you're at, if you don't know about trend following, I still think that you could take the month-by-month performance track record of Dunn Capital to inception, throw it on the table.
It certainly tells the story.
Right. Throw it on the table at the beginning of a semester, and you could spend the whole semester attempting to reverse engineer how that track record came into existence.
Yeah, it certainly tells the story of trend following in a nutshell in one page.
It's fantastic. It's fantastic stuff. Hey guys, I appreciate it. Thank you for coming on.
Thank you.
Thank you, Michael.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.